Hello, this is Nataraja. Welcome to a special mutual fund report. This is about debt fund scenario in India, appreciating the variation of performances of these funds. Typically, a debt fund is not so much relevant for an individual investor because various combination of equity and debt funds are available as hybrid funds, and that typically meets the needs of any individual investor. However, if you are a very large net worth individual, you want to be smarter than others. So you would look for some instruments which are better than bank deposits, and we want to leverage the dynamism in the market. In that case, it is debt funds for you. People like you and me probably, though we don't need debt funds today, let's hope there will be a day we would use them. It's more of a positive affirmation. Other than that, this analysis is more of a academic exercise to understand debt fund scenario in India. Also, there is a rumor, or not a rumor, there's an anticipation of interest rates falling in the next 3 to 6 months, in which case debt funds will perk up. Why debt funds will perk up? Because any face value of a debt instrument is usually 100 minus the interest rate. So let's say if the interest rate is say now 7, then that instrument may be worth 100 minus 7, which is 94. Let's say the interest rate falls to 6%, then that instrument will get 100 minus 6, 94. So 1 over 93 is a quite a good return in debt fund. However, in the long run, the returns of a debt fund comes from its interest earnings. So when the interest rates fall, the debt instruments that of course will earn less. So there is a mixed feeling here. At short term, you will make some money with the increased face value of the debt instrument, but in the longer run, you may not get a good interest. So in such case, people tend to lock into longer maturity instruments. Not that everybody will do that, because many a time people need to park money between various investments. Uh, they may want to park it for very short duration or medium duration. So they would consider different funds for that, which we will see as we get into the discussion of debt funds. So when I created the blog for that, I looked for crisp definitions of various types of debt funds. I could not find them in one place. So I kind of hodgepodged across various sources like Amphi and some of the fund houses. And I was not satisfied, but I had to quickly do something so that people have a basic understanding. In this video, I have tried to clean up, especially I have removed those funds which are not mentioned in the value research report at all, so that there is no distraction. Let me start with the presentation. So basically, this is as on August 23rd, 2024. So almost a week back. I didn't get time to do this video. So now I'm doing it. Should not matter, because anyway, this is more of a understanding based effort. Let's try to understand the debt fund types. There is something called liquid funds. See, liquid funds are very short-term debt instruments. Portfolio maturity is usually less than 91 days. Okay, so instead of putting the money in the savings bank, where you get 3 to 5%, we hope to get more in liquid funds. Then there is a mention of income funds. But in this report, value research doesn't talk about income funds. In other places, I have seen names like ultra short-term income funds, long-term income funds. So I have clubbed these two under income funds. Here, between ultra short-term and long-term, of course, the focus is to generate income, but the differential is the portfolio maturity. For ultra short-term, it is less than a year. Short-term, it is 1 to 3 years. For long-term, it is 3 to 10 years. So that is the key differential. Then you might have heard of gilt funds. These are primarily government securities and considered very low risk, because government cannot default. And if it defaults, the you know the whole state or a country will go for dogs. So there are certain things are so big they cannot fail. So therefore, people who are investing in guild funds are safe that way. So people go for better safety will consider guild funds, and these guild funds are portfolio maturities between 3 to 20 years, because the government raises this money for various projects, so they need longer maturity time. Then there is something called dynamic bond funds. Basically, dynamic bond funds leverage the interest rate changes in the market. Interest rates may go up or go down. So depending on that, they will manipulate the portfolio maturity date and investments. So it is bit dynamic. We'll see how it has helped recently. Fixed maturity plans. Fixed maturity plans are primarily closed-ended funds, and they have a fixed maturity date. So the investment horizon is very clear. This is passively managed, alternative to FTs with investment horizon up to over 3 years. Then there is something called target maturity funds. So what is the difference between the two? The main difference is, while fixed maturity plans are closed-ended, TMs are open-ended. That's one difference. FMPs have a predefined maturity period that can vary from 30 days to 5 years. Okay. So here it said over 3 years. I got another definition here, 30 days to 5 years. So these definitions vary a bit, don't worry, because when it is a mutual fund, they will typically go by practical considerations. So they don't go by pure definition, academic definition. So they will be bound by only certain regulator-based constraints. Okay, so don't worry about variation in the definitions. While TMFs can have maturity periods between 1 to 15 years. So TMFs have longer maturity time, you could say. FMPs are short-term investments. TMFs are long-term schemes. Since FMPs are closed-ended and TMFs are open-ended, so investors can withdraw at any time. That is TMFs. So it is more flexible. Corporate bond funds, typically corporate bonds, you buy corporate bonds. The corporate bond risk rate is identified or certified by certifying agencies. They give definitely higher returns on government securities because they carry higher risk. If the company goes to bankruptcy, then the bonds owners will get a lower priority, not as low as the shareholders, but still there is a risk for the bondholders. Then floating rate funds, FRF, are variant of income funds with a primary aim of minimizing the volatility of instrument returns that is usually associated with the income fund. So FRFs invest primarily in instruments that offer floating interest rates. Now, since it's a floating rate, you need some benchmark, and typically it is Mumbai Interbank Offer Rate, MIBOR. So this rate defines the benchmark for these instruments. Interest rate is reset periodically based on the interest rate movement. The objective of FRFs is to offer steady returns to investors in line with the prevailing market interest rates. Okay. So next is overnight funds. These funds invest in securities having maturity of 1 day, typically money market instruments. So this is type of a money market, but it's just 1 day. Liquidity and convenience rather than high returns. Got it, no? So let's say you have money coming in and going out of your portfolio regular basis. Even for 1 day you want to earn interest, you will park it here. So that is the game here. Low duration funds. These funds are moderately risky and provide reasonable returns. They're useful for those looking to invest for around 6 months to 1 year. Portfolio may include bonds with a weaker credit rating. Short duration funds invest in judicious combination short and long-term debt, as well as across credit ratings. So these funds recommended for investment horizon to 1 to 3 years. Here it was 6 months, it's 1 to 3 years. Then money market funds. These funds invest in money market instruments with a maturity of up to 1 year. They aim to generate returns from interest income, while their slightly longer duration offers some scope for capital gains. Money market instruments are certificates of deposit, treasury bills, etc., are highly liquid short-term assets. Such financial instruments are traded for less than a year. On the other hand, capital market instruments like bonds and shares are traded for the longer term. So there is a separate market called money market, instrument market. So if you are not in it, don't worry too much. If you are into it, you can learn more. Credit risk funds. These funds invest a minimum of 65% of total assets in corporate bonds rated AA or below. That is why they usually generate higher yields as compared to the more conservative corporate bond funds. Investors who are willing to take on higher risk will consider this. Imagine you are interested in corporate bonds. Now, one particular bond you invest, let's say it goes bankrupt, you're in trouble. So you would rather go for a credit risk fund where they manage this risk across the portfolio. You may do better considering here. Banking and PSU funds. These funds invest at least 80% of total assets in debt instruments issued by banks, PSUs, and public financial institutions. This is a moderate risk product that seeks balance, yield, safety, and liquidity. Got it? Huh? It's slightly more higher risk compared to the gilt, but public sector government usually protects them, so you may be okay here. Other funds, US, there is a category called other funds in the report that is basically US Treasury based funds. Now let us get into the performance report. You have seen this kind of a format. So basically entire debt fund universe has 486 funds in India. Okay. Now their average return for 1 week was 0.2, for 1 month 0.88, for 3 months 2.28, 6 months 4.17, and 1 year 8.16. But when you get into subtype, you will see the variations. Now I have sorted this in the ranking. So this ranking is based on the average ranking across 1 week to 1 year. And so you cannot say therefore that any fund with highest annual return will be top. For example, here others, which is US Treasury based, had a 19th position when it comes to annual return, but it has done well on a weekly basis. It is second, and 1 month, 3 months, and 6 months basis it is one. Why? Because US Treasury, US debt instruments have been appreciating in value in anticipation of interest rate cut. So US is a more efficient market for debt. So it has already made progress. If you notice, annual interest rate is around 6.48, but their short-term returns have been more than that. For example, 6 months return is 5.42. If you multiply by 2, it is more than 10. 3 months return is 4.97. If you multiply by 4, it is more than 15%. 1 month return, if you multiply by 12, it's more than 24%. So here is a case, by investing in this debt fund, you would have made quite a good return, right? So that's a good example here. Now let us see the ranking based, the long duration funds have given you the best returns, 11.07% annualized. Next is dynamic bond funds, 9.23% annualized. Gilt, 8.92%. The US based funds I discussed already. Gilt with 10-year constant duration. So it is a gilt fund with the duration being constant 10 years, has given 9.1, slightly better than the other type of gilt funds. Medium to long duration 8.77, floater is 8.43, target maturity 8.37, medium duration 8.29, credit risk 9.11, because it's a higher risk, so higher return here. But it has not done well in the last two recent two segments, weekly and monthly. So it is 16th, 12th, 10th, 8th. So credit rate instruments are losing shine. Okay, probably This return also was very high earlier year, I guess. Corporate bonds 7.98%, banking and PSU 7.88%, short duration 8.05, low duration 7.65, money market 7.58. See, this money market is a replacement for your SB account. So it is a very good return compared to SB return, right? So ultra short duration 7.51, liquid 7.05, fixed maturity 6.95, overnight 6.79. So you can see that the lowest return is overnight because it's just for 1 day, right? So still you get 6.79, it is very good. So this is, see, another thing here, you know that the average across all the debt funds is given here. Any return which is above than that average is marked green. Any return which is below that is marked in red. So as you go down the table, you'll see more red, therefore. And also, if you notice, the breakup of various funds are given here. The popular funds, meaning in terms of number of funds available, target maturity, there are 100 funds. Then fixed maturity, there are 91 funds. So if you add all these, they come to a total 91 more than this number. I am unable to spend time to figure out that discrepancy, but it's not important for this analysis. So let us move on. So now we are going to discuss each subtype debt fund one by one. Now the concept for green and amber is same. So any return higher than the average below is marked bold, and those funds with the above average return from 1 month to 1 year are marked in green, and those with the same but missing out only on one timeline would be marked in amber. So green definitely are safe for consistency, but amber also may be considerable because maybe they slipped in one timeline, they may catch up, that kind of a concept. So long duration funds average is 11.07. Among the ones, let's discuss those which are green and giving good return annually. Nippon India Nivesh Lakshya Fund, Axis Long Duration Fund, HDFC Long Duration Debt Fund. So these three are in green. So that is about long duration funds. There are only 9 funds here. Next, we are going to dynamic bond funds. There are 29 funds. Average return is 9.23 annualized. And the one in green are Bandhan Dynamic Bond Fund, Kotak Dynamic Bond Fund, PGM India Dynamic Bond Fund, HDFC Dynamic Debt Fund, SBI Dynamic Bond Fund, Axis All Seasons Debt FOF, DSP Strategic Bond Fund, HSBC Dynamic Bond Fund. And here the highest return is 11.58 by Bandhan Dynamic Bond Fund. Next one is gilt funds. There are 31 gilt funds. Average return is 8.92 annualized. And the one in green, there are many. I will discuss only the top 5. PGM India Gilt Fund, SBI Magnum Gilt Fund, Kotak Gilt Investment, Kotak Gilt Investment Provident Fund and Trust Plan, Axis Gilt Fund. And the highest annual return has come from Bandhan Government Securities Fund, 11.92. And one more UNESCO India Gilt Fund, 11.21. So next is debt others, which is basically US Treasury West Funds. You can see the name US Treasury here. The average is 6.48 and 3 are in green. Axis US Treasury Dynamic Bond, DSP US Treasury FOF, Aditya Birla Sun Life US Treasury 3 to 10 years bond, ETFs FOF. And if you see the returns in 3 months, they are given 5.9 to 7.15. So this is pretty good for, and it might improve further if the interest rates start falling. Next is gilt with the 10-year constant duration. Only 9 funds are there. None have made it to green status because there has been some kind of a churn out lately. So only certain things are in amber. Average is 9.1 and the highest annual return is by Bandhan Government Securities Fund. Next is medium to long duration fund. There are 14 here. Average return is 8.77 annualized. The one in green are LICMF medium to long duration fund, HSBC medium to long duration fund, Nippon India Income Fund, Kotak Bond Fund, HDFC Income Fund, Canara Robeco Income Fund. Highest annual return here is 9.18. Next one is floater. So among floater, average is 8.43. The one in green are Axis Floater Fund, Baroda BNP Paribas Floater Fund, DSP Floater Fund, Franklin India Floating Rate Fund, ICICI Prudential Floating Interest Fund. Highest return is Axis Floater Fund, 9.76 for the year. So next, so this is target maturity fund. So we have considered only top 50 here, and average is 8.8 for the top 50. And there are many in the green. I'll read very few, maybe 5. UTI CRISIL SDL maturity April 2033 index fund, Bharat Bond ETF FOF April 2033, Kotak Nifty SDL July 23 index fund, Axis CRISIL IBX SDL June 2034 debt index fund, Edelweiss Crisis IBX 50/50 gilt plus SDL April 2037 index fund. Here the highest return has come at 10.11, which is by HDFC Nifty GSEC June 2036 index fund. Next is medium duration fund. There are 24 with an average return of 8.29 annualized. The one in green are Kotak Medium Term Fund, HDFC Medium Term Debt Fund, Aditya Birla Sun Life Medium Term Plan, Axis Strategic Bond Fund. The best return has come at 9.85 by Kotak Medium Term Fund. Next is credit risk funds. Now, credit risk funds are high risk instruments. So if you notice, the one in green are Kotak Credit Risk Fund, Aditya Birla Sun Life Credit Risk Fund, ICICI Prudential Credit Risk Fund. Now, the one that has been doing very well with respect to returns has been DSP Credit Risk Fund. Now it is 16.61 annualized, but off late it is slowing down in returns. So it didn't even get a amber or green status. So it is losing favor by its performance. So among the green, highest is 9.75%. And probably DSP Credit Risk Fund was a darling last year. So somehow it is losing its charm lately. Next is corporate bond funds. There are 23 bond funds, 7.98 is annual average. The one in green are Kotak Corporate Bond Fund, Nippon India Corporate Bond Fund, Axis Corporate Bond Fund, Debt Fund, HDFC Corporate Bond Fund, Aditya Birla Sun Life Corporate Bond Fund, Invesco India Corporate Bond Fund, Tata Corporate Bond Fund. Now, the highest return among the green ones is 8.34 by HDFC Corporate Bond Fund. Next is banking and PSU fund. There are 22. Average return is 7.88 annualized. The one in green, DSP Banking and PSU Debt Fund, Bajaj Finserv Banking and PSU Fund, Kotak Banking and PSU Debt Fund, UNESCO India Banking and PSU Fund, Edelweiss Banking and PSU Debt Fund, LICMF Banking and PSU Fund, Nippon India Banking and PSU Debt Fund, SBI Banking and PSU Fund, Aditya Birla Sun Life Banking and PSU Debt Fund, HDFC Banking and PSU Debt Fund. The highest annual return among the ones that are in green has come from DSP Banking and PSU Debt Fund at 8.38%. Next one is short duration funds. There are 27 funds. Average return is 8.05. The one in green are Edelweiss CRISIL IBX 50/50 gilt plus SDL short duration index fund, Kotak bond short-term fund, Mahindra Manulife short duration fund, Nippon India short-term fund, HDFC short-term debt fund, LICMF short duration fund, Bandhan bond fund short-term plan, ICICI Prudential short-term fund, Area Asset short duration fund. The highest return among the green ones is, I think it's 8.44 by Mahindra Manulife short duration fund. Next one is low duration funds. There are 24 funds. Average return is 7.65. One in green are HDFC low duration fund, ICICI Prudential Savings Fund, SBI Magnum low duration fund, Axis Treasury Advantage Fund, Kotak low duration fund, Mirae Asset low duration fund, Mahindra Manulife low duration fund. Highest return is by HDFC low duration fund and ICICI Prudential Savings Fund among the greens. Next is money market. Average return is 7.58. There are a lot in green. First five are Mirae Asset Money Market Fund, Aditya Birla Sun Life Money Manager Fund, Axis Money Market Fund, Bandhan Money Manager Fund, Franklin India Money Market Fund. Highest return among the green ones is 7.79 by Aditya Birla Sun Life Money Manager Fund. Next is ultra short duration, 7.51 is average return. There are 26 funds. The sum on the top green ones are Mirae Asset, Ultra Short Duration Fund, Aditya Birla Sun Life Savings Fund, Axis Ultra Short Term Fund, HDFC Ultra Short Term Fund, ICICI Prudential Ultra Short Term Fund, UNESCO India Ultra Short Duration Fund. Highest return among the green ones is 7.84 by Nippon India Ultra Short Duration Fund. Next is liquid funds. There are totally 47 funds. Average is 7.05. There are many in green. The top five are Aditya Birla Sun Life Liquid Fund, Axis Liquid Fund, Bajaj Finserv Liquid Fund, Bandhan Liquid Fund, Bank of India Liquid Fund, Baroda BNP Paribas Liquid Fund. The best annual return is 7.50, I guess, and that is by 7.50 is by Edelweiss Liquid Fund. Then fixed maturity fund, average return is 8.31 annualized. Some of them in the top green are Kotak FMP series 304 319 days. Direct plan, HDFC FMP 2638D February 2023. SBI fixed maturity plan series 34. Nippon India Fixed Horizon Fund XLI. Then Bandhan Fixed Plan Series 179. Highest return is 9.9 by Kotak FMP Series 304 3119 days. And finally, overnight funds. Average annual return is 6.79. Among the green ones, top one is Bank of India Overnight Fund, Aditya Birla Sun Life Overnight Fund, Axis Overnight Fund, Bajaj Finserv Overnight Fund, Bandhan Overnight Fund. And the highest return is 6.89 by Bank of India Overnight Fund. So all these tables you have seen were sorted by the descending order of monthly return. So I forgot to mention that. So usual disclaimer, this is not a solicitation for any mutual fund investment, and it is also not a recommendation for any investment. It is just for you to get the distinction by performance. You should be responsible on your own investment decisions. Now, you would see all my blogs and associated videos in various social network platforms. One highlight here is the blog comes first, which is natfuncorner.blogspot.com. So if you type this, you should get that. WhatsApp group is because it is not just for mutual funds. It's also, I'm a short-term and a day trader. So there are many peers like me. We exchange views on a regular basis, on a daily basis before market opens and after market closes. So it is useful if you're a short-term or a day trader. And in that case, this is what you can use to request for joining this group. In the blog, you can press the link here, you can. So that brings to the end of this presentation. So hope this will get you some clarity as to what debt funds. There are some recognized platforms if you want to invest in debt funds. I will mention the names next time because personally I am not doing any investments in debt funds right now. Whatever I need as a safest investment, I have kept it in FDs. They are also in FDs. You should know that government protects only up to 5 lakhs on your FD per account. So if you are husband and wife, you can get protection for 20 lakhs, because let's say husband is A, wife is B. It is A, B, AB, and BA. So these four are considered four different accounts. So you get 20 lakhs by using two people's name. So if you are using three people's, it will become more combination, probably 15 or so. In which case you get coverage up to 75 lakhs. So there are ways you can protect risks on fixed deposits. Do not put fixed deposits without protection, especially in smaller banks, cooperative societies and cooperative banks, because people have been losing money quite often. So be careful out there. Debt funds as an alternative can have their own risk because these are market driven, so it can have some issue. But within debt funds, there are some risk protected funds like gilt, etc. So, but typically people don't want to go to debt funds if they don't have too much money. Got it, no? So you should have at least 1 crore rupees to invest outside to take all that trouble. Not that you cannot do less than that. You don't get motivated to work for that, is what I feel. So with that, I end this presentation. And when the interest rates fall in the next 3 months, we will do this report again and compare the returns now and later, and see the impact where the interest rate falling has impacted the returns and how. That is the more of a curiosity. So I'll see you then on debt funds again. Thank you so much.